Hi, in this video, we will be discussing the journal entries for treatment of goodwill under various methods at the time of admission of a partner. So we have 6 cases before us. The first case is when premium for goodwill is paid privately. The second case, premium for goodwill is brought in cash and retained in the business. Third case, premium for goodwill is brought in cash and is withdrawn. Fourth case, premium for goodwill is brought in kind. Fifth case, only part of premium for goodwill is brought in cash by the incoming partner. And the final case, when the incoming partner does not bring in premium for goodwill. We'll start with the first case, which is premium for goodwill is paid privately. Let's say A and B are partners sharing profits in 3:2. They admit C for 1/4 share. C brings in rupees 2 lakh as capital and goodwill of the firm is rupees 1,60,000. C pays premium for goodwill privately to A and B. So we have here that the capital brought in by C is rupees 2 lakh and that C pays the premium for goodwill privately to A and B. Let's calculate C's share of goodwill. To calculate the amount of compensation or premium for goodwill C has to pay, we need to take the goodwill of the firm 1,60,000 and multiply it by the share of C, which is 1/4. So we arrive that premium for goodwill to be paid by C is equal to rupees 40,000. However, in this first case, the 40,000 rupees is paid privately by C to A and B. As far as journal entries are concerned, we need to pass the journal entry only for the capital which is brought in by C, which is bank account debit to C's capital account rupees 2 lakh for the capital brought in by C. Since the premium for goodwill is paid privately by C to A and B, there will be no journal entry for the same in the books of the firm. The second method, premium for goodwill is brought in cash and retained in business. Let's say A and B are partners sharing profits in 3:2. They admit C for 1/4 share. C brings in rupees 2 lakh as capital and his share of goodwill, which is retained in the business. Goodwill of the firm is equal to rupees 1,60,000. So now we have here that C brings in cash rupees 2 lakh as capital and also his share of premium for goodwill. And C's share of premium for goodwill is rupees 1,60,000 multiplied by 1/4, which is rupees 40,000. So the first entry for the capital and the premium for goodwill brought in cash is we debit bank account with rupees 2,40,000, the total amount which is received by the firm, to C's capital account for the amount of capital brought in by C, rupees 2 lakh, and to premium for goodwill for the premium for goodwill brought in by C, rupees 40,000. Narration: being capital and premium for goodwill brought in by C. Now the second entry is to distribute the premium for goodwill rupees 40,000, which is brought in by C, among the sacrificing partners in their sacrificing ratio. Now in this particular example, the sacrificing ratio is equal to the old ratio, which is 3:2. So let's see the journal entry for the distribution of premium for goodwill. We need to debit premium for goodwill account with rupees 40,000 to A's capital or current account and to B's capital or current account. A gets 40,000 rupees into 3 divided by 5, which is rupees 24,000, and B gets rupees 40,000 into 2 divided by 5, which is rupees 16,000. In case of fluctuating capital method, we will credit to A and B's capital account, whereas in the case of fixed capital method, we will credit to A and B's current account. Narration being premium for goodwill distributed amongst the sacrificing partners in the sacrificing ratio. So where the premium for goodwill is brought in cash by the incoming partner and retained in the business, we will have two journal entries. One journal entry for the capital and the premium for goodwill which is brought in cash, and the second entry for distributing the PFG among the sacrificing partners in their sacrificing ratio. Method 3. Premium for goodwill is brought in cash and is withdrawn. When premium for goodwill is brought in cash and is withdrawn by the sacrificing partners, the sacrificing partners may decide to withdraw the premium for goodwill fully or to only withdraw part of the premium for goodwill. We will discuss these two cases separately. Let's say the sacrificing partners decide to withdraw the premium for goodwill fully. We have A and B as partners sharing profits in 3:2. They admit C for 1/4 share. C brings in rupees 2 lakh as capital and his share of goodwill, which is fully withdrawn by A and B. Goodwill of the firm is equal to rupees 1,60,000. So C brings in capital and his share of goodwill in cash. C's share of goodwill is rupees 1,60,000 into 1/4, which equals rupees 40,000. So let's see the journal entries. The first journal entry is for the capital and the premium for goodwill brought in cash by the partner C. We'll debit bank account with rupees 2,40,000 to C's capital account with the amount of capital rupees 2 lakh, to premium for goodwill for the amount of premium for goodwill rupees 40,000. Narration being capital and premium for goodwill brought in by C. The next journal entry is for distributing the premium for goodwill, which is brought in by C amongst the sacrificing partners in the sacrificing ratio. Here again the sacrificing ratio between A and B is 3:2. The journal entry for distribution: premium for goodwill account debit rupees 40,000 to A's capital or current account rupees 24,000, to B's capital or current account rupees 16,000. Narration being the premium for goodwill distributed amongst the sacrificing partners in sacrificing ratio. the amount of premium for goodwill which has to be credited to A and which has to be credited to B is the same as discussed in the second method. The sacrificing ratio is 3:2. So A gets 40,000 into 3 by 5 and B gets 40,000 into 2 divided by 5. In this case, however, there is an additional journal entry because the sacrificing partners are withdrawing the premium for goodwill. So since it's fully withdrawn, the journal entry is A's capital or current account debit rupees 24,000, B's capital or current account debit rupees 16,000, to bank account rupees 40,000, being the premium for goodwill fully withdrawn by A and B. So A and B fully withdraw the amount of rupees 40,000. A takes 24,000 and B takes rupees 16,000. So in this case, we have 3 journal entries. The first one for the capital and the premium for goodwill brought in cash. The second entry for distributing the premium for goodwill among the sacrificing partners in sacrificing ratio. And the third journal entry for the withdrawal of premium for goodwill by the sacrificing partners. Now what if the sacrificing partners decide to only partly withdraw the amount of premium for goodwill? A and B are partners sharing profits in 3:2. They admit C for 1/4 share. C brings in rupees 2 lakh as capital and his share of goodwill, which is half withdrawn by A and B. Goodwill of the firm is rupees 1,60,000. So as in the other cases, C share of goodwill is 1,60,000 rupees into 1 divided by 4 or rupees 40,000. Now out of this 40,000, half of it, rupees 20,000, has been withdrawn by A and B. The first journal entry is for the capital and premium for goodwill brought in by C. Bank account debit rupees 2,40,000 to C's capital account rupees 2 lakh, to premium for goodwill rupees 40,000 for the capital and premium for goodwill brought in by C. The second entry is for distributing the premium for goodwill amongst the sacrificing partners in their sacrificing ratio. Premium for goodwill account debit rupees 40,000 to A's capital or current account rupees 24,000, to B's capital or current account rupees 16,000, being the premium for goodwill distributed amongst the sacrificing partners in their sacrificing ratio. Now in the third journal entry, the only difference is only half of the amount is withdrawn by A and B. So we debit A's capital or current account with rupees 12,000, which is half of the rupees 24,000 which he was entitled to. We'll debit B's capital or current account with rupees 8,000, again half of the rupees 16,000 which was his share, and we'll credit bank account with rupees 20,000, the total amount which is withdrawn by A and B together from the firm. So narration being premium for goodwill half withdrawn by A and B. So we saw the journal entries when the premium for goodwill is brought in cash and is withdrawn by the sacrificing partners, whether fully or whether partly. The fourth method, when premium for goodwill is brought in kind. So in this case, the incoming partner brings in premium for goodwill in a form which is other than cash. A and B are partners sharing profits in 3:2. They admit C for 1/4 share. C brings in the following assets as his capital and his share of goodwill. The assets are stock rupees 1 lakh, debtors rupees 50,000 and building rupees 1 lakh 50,000. Goodwill of the firm is equal to rupees 1 lakh 60,000. Now C has brought in assets for his capital and his share of goodwill. The total assets which is brought in by C is rupees 1 lakh stock plus rupees 50,000 debtors plus rupees 1 lakh 50,000 building, totaling rupees 3 lakh. Now they haven't said the amount of capital which is brought in, but we know that C share of goodwill is 1 lakh 60,000 multiplied by his share 1 by 4, which comes up to rupees 40,000. So the difference we will consider as C's capital. So the first journal entry is for the capital and the premium for goodwill, which is brought in kind by incoming partner C. We'll debit stock account with rupees 1 lakh. We'll debit debtors account with rupees 50,000. We'll debit building account with rupees 1 lakh 50,000. Since the premium for goodwill is 40,000, the difference is the capital contribution by C, that is rupees 3 lakh total assets minus C share of goodwill rupees 40,000, coming up to rupees 2 lakh 60,000. So we'll credit to C's capital account rupees 2 lakh 60,000 and to premium for goodwill rupees 40,000. Narration: being capital and the premium for goodwill brought in kind by partner C. Now the second entry is the usual entry for distributing the rupees 40,000 premium for goodwill amongst the sacrificing partners A and B in their sacrificing ratio, which in this case also is 3:2. So the journal entry for the same: premium for goodwill account debit rupees 40,000 to A's capital occurring account rupees 24,000 to B's capital occurring account rupees 16,000. Narration: being the premium for goodwill distributed amongst the sacrificing partners in the sacrificing ratio. So this method of treatment, instead of debiting bank, we will debit the assets which is brought in by the incoming partner, and we will calculate the capital which is brought in by him by taking the total value of the assets minus his share of premium for goodwill. The fifth method: when only part of the premium for goodwill is brought in cash. A and B are partners sharing profits in 3:2. They admit C for 1 by 4 share. C brings in rupees 2 lakh as capital and rupees 30,000 out of his share of goodwill. Goodwill of the firm rupees 1 lakh 60,000. So C share of goodwill is actually rupees 1 lakh 60,000 into 1 by 4 or rupees 40,000, but C brings in only rupees 30,000 out of this share of goodwill of rupees 40,000. Let's see how we'll deal with this. The first journal entry is for the capital rupees 2 lakh and the premium for goodwill rupees 30,000, which is brought in cash. Journal entry: we'll debit bank account in the books of the firm for rupees 2 lakh 30,000 to C's capital account rupees 2 lakh, to premium for goodwill rupees 30,000 for the amount of premium for goodwill brought in cash by C. So being capital and premium for goodwill brought in by C. The second entry is for adjusting the goodwill among the sacrificing partners in the sacrificing ratio. The sacrificing partners are A and B, and the sacrificing ratio is 3:2. Now, premium for goodwill which is brought in cash is only rupees 30,000. So for the difference, the share of goodwill of C which is not brought by him in cash, in this case rupees 10,000, which is rupees 40,000 minus rupees 30,000, this amount of rupees 10,000 will be debited to his current account. So we have in the journal entry, premium for goodwill account debit rupees 30,000, C's current account debit rupees 10,000, to A's capital or current account, A's share rupees 24,000, to B's capital or current account, B's share out of the 40,000 which is rupees 16,000. Narration: being goodwill adjusted among sacrificing partners in sacrificing ratio. Now here the point to note is, in the case of A and B, in the case of fluctuating capital method, A and B's capital account will be credited, whereas in the case of fixed capital method, A and B's current account will be credited. However, in this entry where we've debited C's current account with rupees 10,000, which is the difference, we have to debit C's current account whether the fluctuating capital method is being followed or whether the fixed capital method is being followed. So in either case, the incoming partner's current account needs to be debited with the amount of goodwill which is not brought by him in cash. So the basic approach will be, where the incoming partner does not bring in his share of goodwill in cash fully, for the difference we need to debit the incoming partner's current account. The last method, when the incoming partner does not bring in premium for goodwill. A and B are partners sharing profits in the ratio of 3:2. They admit C for 1/4 share. C brings in rupees 2 lakh as capital but is unable to bring in his share of goodwill premium. Goodwill of the firm is rupees 1,60,000. C share of goodwill is rupees 1,60,000 multiplied by 1/4, which equals rupees 40,000. But as per the example, C is unable to bring in his share of goodwill premium. So he brings in only rupees 2 lakh as his capital. Let's see the journal entries. The first entry is for the capital which is brought in by C in cash. We will debit bank account with rupees 2 lakh and credit C's capital account by rupees 2 lakh for the capital which is brought in by C. The second entry is for adjusting the incoming partner's share of goodwill. Since C does not bring in his share of goodwill, the amount will be debited to his current account. So C's current account debit rupees 40,000. Remember, we need to debit the incoming partner's current account with the amount of premium for goodwill which is not brought in by him, irrespective of whether the fixed capital method is being followed or whether the fluctuating capital method is being followed. So we'll debit C's current account with rupees 40,000 to A's capital or current account, A's share rupees 24,000, and to B's capital or current account, B's share rupees 16,000. Narration: being goodwill adjusted among the sacrificing partners in their sacrificing ratio. So where the incoming partner does not bring in his share of goodwill, we will debit the incoming partner's current account with the amount of goodwill which is not brought in by him. So in this video, we've seen all the 6 methods of goodwill treatment at the time of admission of a partner.